Good afternoon, everyone. Welcome to today's webinar, a macroeconomic view of the markets. Today's presenter is Frank Hatheway. Welcome, Frank.
Hi, Tom. Thanks very much. Great to be here.
My pleasure. My name is Tom Hartle. I am CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time. We'll have Frank answer the questions at the end of this presentation. If you're reviewing the presentation in full screen mode, you can find Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. We'll be recording today's webinar, and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. Today's webinar is brought to you by Nasdaq eSpeed, an electronic trading and market data platform for institutional traders in the U.S. Treasury market. Nasdaq provides real-time institutional trading of benchmark U.S. Treasury securities and is one of the largest and most liquid fixed income cash markets in the world. Nasdaq exclusively extracts the data from this platform to power trading algorithms and is used to generate prices in other fixed income products such as interest rate swaps, corporate bonds, mortgage products, and is used to support valuations and other fixed income products. eSpeed market data is available in real time, intraday, end of day, and historical, as well as indicative formats for the following instruments: Treasury bills, Treasury notes, Treasury bonds, Treasury floating rate notes. For a free trial, please visit cqg.com/NASDAQ eSpeed free trial. Now, using Integrated Client enables you to monitor and trade the U.S. Treasury market, spread treasuries for yield curve plays, develop trading systems, and much more. In addition, you can connect CQG to Excel and bring in market data on a real-time basis for more analysis and building your own dashboards. You can learn more about using Excel with CQG at news.cqg.com. Now, it's my pleasure to introduce Frank Hatheway. Dr. Hatheway earned his PhD in economics from Princeton University. Today, he is Chief Economist of the Nasdaq Group and leads the Economics and Statistical Research Department. His team is responsible for a variety of projects and initiatives in the U.S. and Europe. Their goal is to improve market structure, encourage capital formation, and enhance trading efficiency. His background includes teaching finance at Penn State. He served as an economic fellow and senior research scholar with the SEC, and he was a derivatives trader. And now, Frank, I'm happy to turn the webinar over to you.
All right. Well, thanks again, Tom, and I want to thank CQG for giving me the opportunity to talk to everyone today, and I'd like to thank all of you in the audience for your time this afternoon. A little bit of background on what we're going to do. This is not going to be a piece on tactically trading fixed income markets tomorrow. That piece would have to be written probably in the early hours of tomorrow morning. What I'm going to do instead is I'm going to just talk about 2 or 3 of the major issues that are confronting the Fed right now and try and give you all a little bit of background and context for how to react to things that you will be seeing and reacting to in real time, like this afternoon's release of the Fed minutes, which sent the stock market into a little bit of a tailspin. So the big issue around this year is, will the Fed achieve what some people have called the Goldilocks outcome, where everything is just right? It's neither too hot nor too cold. And in the context of Fed policy, that means that the liftoff, the increase in short-term interest rates that the Fed engineered last December, is neither too early nor too late. And we'll present some thoughts on why some people claim it was too early and why others are claiming it's too late. But I'm going to try not to be a two-handed economist here and instead give you a more definitive set of views of what I think going to be the state of the economy, which I really do think the Fed is going to be able to engineer this Goldilocks outcome. We will have a relatively stable economy once we get over the current turmoil, and we're going to talk a little bit about some times in the past, and the recent past, where we thought the world was going to come to an end because of fiscal policy or some other event in the world, and in fact it didn't. And I think this is just another one of those periods. Going to just take a couple of slides on some of the things that are the Fed's favorite views of the economy, focusing really around the labor market, and then a couple of things that are our favorite views on how investors are reacting to what they read, hear, think about that's out there in the world. And the Fed is right now the big thing. There have been other focal points for investors' thought processes in the past, Greece, plenty of others, China most recently. But the Fed, I think, is the big one we're dealing with right now. So this is what we have right here, and the little chart at the bottom of this page, so we can all sort of get in the same place. Year-over-year GDP growth, it's actually been in a relatively tight range for the last 5 years plus. Forecasted to stay in a tight range going forward, never really getting much below about 1% year-over-year, never really getting much above 3% year-over-year, and most of the time it's coming in somewhere in the middle of that range. It's not been a boom. I think we all know that from our own financial situations probably, and nor has it been a bust. This is not the financial crisis all over again. So where I want to start is I want to start with one view of the job market. And take a minute now explaining what you're all looking at on the right. So what we've done here is we've taken the number of jobs that existed in the economy at the peak before each of 5 of the last recessions, 1974, 1980, 1990, 2001, and the financial crisis. And we say, okay, we'll set the index of the number of jobs in the economy to 0 based on that peak. And we're going to take a look at how many months it takes after the peak for the number of jobs in the economy, not the unemployment rate, just the absolute number of jobs, to get back to where it was. And one of the things that's very striking about the financial crisis is how long it took. It took the better part of 6 years, over 72 months, for the number of jobs in the economy to come back. And that's really, I think, the core of why the Fed has been so focused on jobs in thinking about when to raise rates and in their policy statement today. And I'll come back to that in just a second. It's not really a political argument I'm making here. It's not, Republicans are concerned about inflation, Democrats are concerned about jobs. In this particular recession, everybody has been concerned about jobs because the story for this particular recession has been so different from everything we've seen in all of our collective professional pasts. You have to really go back to recessions that fall perhaps at the edge or outside our human memory and certainly outside our professional memory, to go back to the 30s and to see something that looks like this. If you've had a chance to look at the Fed's press release today, and there's some wonderful tools out there that will take the statement of the current FOMC meeting, compare it to the last one. Most of the changes that were made between January and December were about the job market. And I think that just reinforces the extent to which the Fed focuses very, very heavily on the job market. And I'm not going to read that whole release to you or go through the changes, but just emphasize this is a big deal for the Fed. We'll talk a little bit in a minute why, and we'll talk a little bit about some of the things other than the sheer number of jobs that makes what the Fed's trying to do here a little bit tricky. We have a lot of unemployment rate's okay. Absolute number of jobs, not okay. Number of discouraged workers that are outside the labor force, significant. But what does this all mean in terms of economic growth? Well, jobs drive income, right? And consumer spending is the biggest part of the U.S. economy by far. Actually, as a percent of the economy, it has grown since the financial crisis, in spite of what I just showed you about jobs. So let me just show you what we've got right here. So the chart on the right-hand side, this is disposable income, okay? Absolute dollars, adjusted for inflation. It's kind of after we all pay our taxes and the things that get in the way of us having a good time and going out to dinner and disposing of our income in more entertaining fashions. And there's a couple of key points here. One is prior to the financial crisis, this period of time in here from 2000 through 2007, about just under 3%, 2.8% growth rate in disposable income, okay? Flat line in the financial crisis, no huge surprise. Start growing again, but we start growing again at just under 2%. So we had a gap in how much disposable income there was in the economy. This is not per person or anything else. This is just the absolute number adjusted for inflation, and that gap has been getting bigger. And one of the reasons it's been getting bigger is that people aren't working, as many people aren't working, as has been the case before the recession. Another one that gets in the press a lot and that we may think about from time to time is that the raises that working people got have been lower than was the case before the financial crisis, and in many cases lower than inflation. So we've got this slump in personal income. And since personal income is such an important driver of the economy, this is a big deal if you're the Fed and if you're trying to think about what you need to do and what you need to worry about, and perhaps were you too early in raising rates? Should you have waited a little while for the growth rate in personal income to pick up, the number of people in the labor force to increase, and for things to start looking like, the economy is overheating as opposed to recovering? When we think about what a 6% or 5.8% gap in numbers this big means, that's $1 trillion. Now, for most of you, that may not seem like a lot of money, but for me, it certainly does. And if for any of you it seems like it's not a lot of money, I would be happy to take your pocket change home this evening. One more thing before I go on. As Tom said at the beginning, I spent 8 years as a professor at Penn State. You've been listening to me now patiently for about 10 minutes. Do any of you doubt that I can talk for hours and hours nonstop? I don't think so. So we're going to end with a little time for Q&A. I'd love to respond to questions you have. So if you have any you'd like to ask, don't forget to type them in as I'm talking away. All right, so a picture of the job market, how long it took to get simply the absolute number of jobs back in the economy that we had prior to the financial crisis, very long time. The income effect that has had on the economy as a whole, fairly significant, about $1 trillion. There's another thing about the current job market that I want to turn to now that is a piece of the puzzle for a lot of people, including the Fed, because we don't really understand it. So what we're looking at here is the percent of working age adults that are employed in the organized labor force. And we're going to define working age a little more narrowly than some times it's done in the press. These are people between 24 and 54 years old. These are essentially, in my view, and a lot of people's view, the folks who have to work. They're getting a little too old to still be in school, a little too old to still be living at home. Yes, there's some exceptions. When you get to the folks who are 24 and older, folks 54 and younger, a little too young to be retired. Yes, we all know people who are retired well before they're 54, and yes, we all hate them, but there are not many people like that, okay? So these are the folks essentially who have to work. And as a percent of the economy, it was around 80% for around 20 years. So essentially between the recession at the beginning of the 90s and the recession and the financial crisis, the percent of folks in this core age group is fluctuating around 80%. Global financial crisis hits, it drops to 75%. It has begun increasing. It is still roughly about 4 percentage points below its peak. That's about 7 million people in the United States. That's a lot of people of this group that has to work that doesn't seem to be working. Well, there could be some folks staying in school longer. There could be, we talked about the early retirement group. It could be that. It could be people who went on disability in the financial crisis. We don't know. And changes like this, very long term, you're clearly not setting a bond trading strategy off any of this kind of stuff. But it's a puzzle. It's a puzzle to the Fed. It's a puzzle to other people. And if you think about longer-term trend that I'm showing here, if you went back to, say, the 1950s, the percent of adults in the labor force was in the mid-60% range. And what happened between the 1950s and 1990? Tremendous number of women entered the organized labor force, okay? Significant changes in terms of level of prosperity in the United States, in terms of significant changes in terms of types of goods people bought, people didn't buy, obviously political, societal changes as well. Far too early to say that this 3-4 percentage point drop that we're looking at right now in the number of people in the labor force represents anything significant. It's definitely too early to say whether there's a gender composition or some other demographic composition to it, but it's a puzzle. And it's a puzzle that's an important one because what it may signify for how the economy is going to behave in the years ahead. Could be something as simple as people working but not in a way that can be measured. I don't think there are that many Uber drivers out there in the U.S., but the economy is transitioning. And this is the kind of statistic that the Fed looks at and essentially puzzles over. You know, should we have waited for raising interest rates till we had 80% of the adults back in the labor force, or say 78% or something like that, as opposed to really where we were. All right, so this is another aspect of the too early story that the Fed should have waited. There's also a too late dimension to this. The folks who have been arguing the Fed should have raised rates long ago, and I'll be quite candid, I was one of them. I would have been perfectly happy to see the Fed raise rates in the fall of 2014, not in the early winter of 2015, but you know, they don't listen to me, so it goes. But what are we looking at here? These are two measures of how long it takes to fill a vacancy if you're an employer and you're trying to hire somebody. The purple line goes over to the right-hand side, and that's how long it takes if you're a public sector employer trying to hire somebody. It's just under 40 days right now. The yellow line's the private sector. It goes over here to the left. And if I'm in the private sector and I'm trying to hire somebody, it's about 28 days right now. There are a couple of parts of the economy where it's become really quite difficult, twice as difficult as maybe 6 years ago, or even more so, even 10 years ago, to hire people. And since at some point we all like to have a little information that's about us, I think some of the good news for those of us on this call is that in that category of the professions, one of the professions that's had the biggest increase in days to hire and fill a position is financial services. And I think it's fair to say that most of us on this call are in financial services. It takes, on average, about 43 days to fill a position in financial services now. In the early 2000s, it took 28 days. So that's a pretty big increase. Other bits and pieces that take a while, business and professional service has, again, about a 50% increase from 18 to 27 days. And again, think lawyers, accountants, folks like that. And manufacturing, interestingly enough, is another one that's had a big increase in terms of the number of days it takes to fill a job, from about 17 to 32 days. When it takes time to hire someone, that's a sign that labor, at least of that type, is in short supply. And what this is really saying is that if you have the set of skills that this economy is demanding, it's not a bad economy for you. I haven't talked about construction jobs, and there's no specific line on this graph for construction jobs, but it's about 11 days to fill a construction job. So that's not a skill. It's in a lot of demand right now. And it's not a skill where the labor market is particularly tight. But when a market gets tight, any market, what happens? Well, the price should go up. And this would be the argument that the Fed is essentially too late, that what you see here in 2015, the number of days it takes to hire people in the private sector, is a sign of the tightness of the labor market. That means wages are starting to go up. We're all excited and positive about that one. But if, again, put my gloomy economist hat on, that's not necessarily a good thing. You don't want inflation to get baked into the economy. You like it to be nice and moderate. and the Fed is too late and inflation is already accelerating in ways we may not necessarily see in the headline numbers, that would not necessarily be a good thing for the Fed, and it would be a sign that the Fed's too late. Why do we care about the Fed being too late? Well, if the Fed's too late, they're going to have to raise interest rates more than they currently envision, and they're going to have to slow the economy more than they currently envision, and that, you start leaning in directions of things like stagflation going back to the 70s, that we really don't want to have that particular playbook repeating itself. Okay, so this is just 2 or 3 different perspectives on how to think about the labor market and the different points of view that people have about the labor market, state of the labor market. The Fed is obsessed with the labor market, as probably rightly they should be, given what happened with the Great Recession. And at least from my view, we're a long way away from having salary inflation, wage inflation in the labor force. And the Fed needed to act at some point, if for no other reason than to prove that they know a way out of the quantitative easing policy they've been pursuing for a number of years. And they had a little bit of a problem with the calendar because this is an election year. Now, I'm not going to talk a lot about the impact of the election year on what we're looking at here, but there are some. Here's a very sort of simple way to think about it. You have a whole bunch of people running for arguably the most powerful job in the world. They would like the attention of the press and all the rest of us focused on them, whoever they would happen to be. They're not going to be very appreciative if the Fed begins to raise interest rates or the Fed somehow begins to become the story while they're trying to get attention on themselves. So I think the Fed wanted to get the interest rate first increase out of the way, get any market reactions to it out of the way, well before we got into the heart of the primary and election season, which, as those of us in D.C. know all too well, begins next week in Iowa, and then we'll move ahead at a brisk pace through June, and at which point the Fed will have sort of another window and nobody really gives a hoot about what the Fed's doing. I said at the beginning that we like looking at certain things here in terms of how the investor is behaving. We have a lot. I mean, for us as a equity market, fixed income, derivatives market, commodity market operator, there's lots of different things we look at. I'm just going to talk about a couple right now that are a little broader than some of the other ones we pay attention to. And this, frankly, is one of my favorites because it's very useful for making points about how the market is behaving in the short term. What this purple line is the solid purple line here is the State Street Investor Confidence Index. As you guys know, State Street's a big custodian bank. What they look at is they look at trends in what their custodial clients are buying and selling. And I am much more interested in what people are doing with real money than what they're saying in surveys. So I love looking at stuff like this as opposed to investor surveys or that type of measure of confidence. And there's some interesting things that come out of here. Here's the financial crisis, okay, right down there. What that means is I'm not buying equities. I'm not buying long-dated debt. I'm not buying emerging market. I'm buying T-bills. And when I'm buying T-bills, that's risk off with a capitalized off, and I'm getting the heck out of the market. And here we have, just a little bit later, in 2010, things that look like a lot of investor confidence. Well, that doesn't necessarily mean we thought in early 2010 or late 2009 that the world was wonderful. It just meant we were bottom fishing. And as a former trader, I relate to that. That makes sense. And it has impacts on our businesses and presumably on yours as well, as people begin to say, okay, there's been a little bit too much of a move to cash back here, a little bit too much caution, and we're going to see where the bargains are, and we're going to trade those right now. We get that behind us and then march along through the 2010s, 2011s, 2012s. And if we were spending a little more time on this, I'd be calling out things like the U.S. sovereign debt crisis and budget crisis when the U.S. Treasury debt got downgraded to 2% or downgraded to AA or some of the other things that happened. This one's fun. And I think this gets to the point, one of the points I was making at the beginning about is what we're experiencing right now simply a hiccup, or is it going to be something relatively permanent that'll be affecting us all year? The end of 2012, we were going into the sequester and the fiscal cliff at the beginning of 2013. You know, plenty of you on the call are going to remember that. It was one of the times the world was going to come to an end, that time over fiscal policy, not monetary policy. And what was happening at the end of 2012? And it popped up in the personal income graphs too, but I didn't talk about it back then. A lot of people were front-loading income. Let's do special dividend payments. Let's pay bonuses early. Let's do lots of things because tax rates are going up in 2013. So let's put as much income as we can in 2012. Got this big spike in personal income back in that graph. In this graph, what did it mean? Well, it meant I was generating a lot of cash. It wasn't really meaning I was cautious about the economy. It meant I was generating a lot of cash. And where does cash go when you don't have any better place for it but into things like T-bills or commercial paper or essentially short-term money of various types? So we bounce off that pretty quickly and then come up through the last couple of years with investor confidence in terms of what people are buying and selling, very resilient to things like the Grexit crisis of last June and July. Again, we stopped talking about that, but last summer, the beginning of last summer, you know, one of the ways the world was going to come to an end was over Greece. Drifting down a little bit right now, we're going to see that more in the next slide as well. Nobody really knows how the end of the story that the Fed has been telling since they began quantitative easing is going to play out. So what do? We get cautious. It shows up in the State Street numbers and it shows up in these. What we have here, mutual fund flows. It's a hint at what retail is doing. It's retail buying and selling. It's not perfect, but it's not bad. Blue lines are for equity. Gray lines are for bonds. Above zero means net inflows. Below, net outflows. Financial crisis. Looks a hell of a lot like we'd expect it to. I don't want bonds. I don't want stocks. I don't want anything. You get a lot of noise various times through the following essentially 6 years. You can pick out the various crises and flash crashes and things that hit the equity markets through here, or the bond markets in the case of the taper tantrum and some other things that happened. And then you get into the last 6 months. And in the last 6 months, essentially nobody wants anything. Bonds are being sold off. Equities are being sold off as we're getting ready to see what the heck the Fed's going to do, and more importantly, what the impacts of that are going to be. And so, as was the case in 2013, this means a lot of cash moving into the sidelines. Where does it go? It's staying cash. If the world comes to an end, it could come back to the market fairly quickly. If it doesn't, we know it's not going into oil because of the way oil prices are behaving. But there is a significant move to the sidelines, at least in the mutual fund piece. Exchange traded funds, they're not as big an animal by any means as mutual funds. They're big and they're more important than it used to be, but they're not huge. Again, this is just flows over the course of the year, 2012, 2015 up here in red. Kind of the amount of money flowing into fixed income exchange traded products of all types slowed down. But it was still trending up, unlike what was happening in mutual funds, but just not trending up as quickly as it was earlier in the year. And certainly these inflows are not big enough to offset what was coming out of bond funds in the second half of 2015. Okay. Well, I'm going to let you all ask me anything you want to ask me, at least anything you want to ask me about the economy in just a second. Before I do that, let me just wrap up. If we get a steady as we go outcome, that Goldilocks economy, the Fed will probably not get a lot of credit for it. Consequently, it shouldn't get all the blame if we don't get it. there's a lot of other things going on out there in the economy, and we've touched on them: Chinese economic growth, oil in the immediate short term. Most of these things don't really have a lot to do with what the Fed did in December. The Fed has impact globally. I'm not sure it has that kind of impact on some of those, either the Chinese economy as a whole or the oil market in its entirety. But so there's other things going on around the world that can create volatility in the market. But for us, and for what I'm trying to impart to you all today, the perceptions of what the Fed will do, as well as the actual actions of what the Fed does, and in turn views on the economy that people think the Fed is going to look at, they're going to have a big impact on the markets. It had a big impact this year. So far, they will continue to have an impact. Will it be an impact where we say, okay, the Fed actually did kind of know what it's doing, and we're getting the economy sort of weaned off quantitative easing, off the drug, if you will, and stabilizing and standing really on its own feet now as you move into 7th, 8th year after the financial crisis? Or if you all would ring me up a year from now and tell me, boy, I got it wrong, that January was just the first volatile down month of what turned into a absolutely horrible year. I don't think that's going to be the case. I think we're going to have a relatively stable case, and like with the fiscal cliff and the sequester, once we get some numbers from the economy behind us as we go through this quarter into the second quarter, the economy will stabilize. But that's my view. All right. So, Tom, that's the formal part of what I wanted to say to your audience today. If we have questions, I'll be happy to take them.
All right. Thank you very much, Frank, for a very thoughtful presentation. We do have a few questions here. The first one was a lot of people working in the underground economy. Are a lot of people working in the underground economy? And if so, how can you, work this out or work this into your thoughts?
I'd say that there are more people in the underground economy in different types of positions than would have been the case before the financial crisis. I made a quip about Uber, but there are also a fair amount of high-skilled jobs where people are operating essentially as freelancers. And one of the things that makes that type of activity work, both the employer and the employee, is if it's off the tax rolls, if not completely off the books. And I think that's attractive to a lot of people for a variety of reasons. The question for the Fed, and you've heard Senator Clinton have a different take on this a few months ago, but the question for the Fed is, all right, are those people actually out there, they're working, they're gainfully employed, they're contributing to the economy, we're just not measuring them? Or not. And, of course, Senator Clinton's point was that we should start measuring them and get them covered by regulation and paying taxes and all that kind of thing, which kind of destroys the model, but that's a whole different story. The short answer is people don't know. These are folks, if these positions exist, there are reasons that people in them do not particularly want to be measured in conventional ways. Uber doesn't want to view their drivers as employees. So if you get employment data for Uber, you'll get data on the people who run the infrastructure that is Uber. You will not get employment data on drivers, for example. And there are lots of other businesses potentially that would feel the same way and would have, good practical reasons for not treating people they consider independent contractors as employees when responding to government surveys or what have you. If that's the case, what we'll see as these people begin to be measured, because the government loves to measure and tax things, is that participation rate bounce up toward 80. And it'll bounce up toward 80 without really much of anything else happening in the economy. If it's not the case, and we enter another recession, and we will at some point in time, we don't go, the economy never goes up forever, we're going to see more ratcheting down in that employment participation rate. And that's kind of a problem. That is a change in terms of the quality of life that all of us can support because, frankly, we have fewer adults working in a household or as individuals or what have you. but I do think that I just don't think there's that many in the underground economy. I think we're seeing something about a shift in people's work habits. And one of the examples I've given people in other conversations is when I was growing up and going through school, there was no such thing as a gap year. You went to high school, you went straight from high school to college, you went straight from college to your first job. You might take a couple months off over the summer, but that was about it. As I raised my children, there were gap years. There were gap years in high school, there were gap years in college, and now I'm reading that there are gap years in people's professional careers. Folks in their late 20s and early 30s will take a year off. And you know, the pejorative phrase would be to go find themselves, but they know who they are and they know where they are. They're just taking a year off to think about things and recharge, and that's different. That's a different aspect of the economy, and it would frankly mean there's really nothing wrong with the participation rates. You just have a lot of people who are taking a gap year as a 30-year-old, and that's something we haven't really come to terms with.
Okay, thank you. That same individual also asked about your chart regarding the 24 to 54-year-old population ratio. Is that the same? What's going on in Australia is what the question was. Do you see the same thing in Australia by chance?
That I can't answer. I wouldn't know to the extent that it's in Australia. I would say you see the same thing in some of the Eurozone countries that have particularly been in the headlines, the pigs, if you will, because the unemployment rates there are so high. The official unemployment rates there are so high. It doesn't jive with what you see on the ground if you visit. They're not crowds of people standing around street corners with nothing better to do, which is one of the things you do see in an economy with large unemployment rates. And again, 8 years after the financial crisis, there isn't a significant amount of civil violence. And that is, again, something you usually see with unemployment rates as high as the official numbers in those economies. So if we were to look at numbers like this from Spain or from Italy, we'd again have to go, okay, a lot of people not working, but is this accurate? Or are a lot of people somehow not being measured as working, but are working as baristas in London or whatever the case may be, and are supporting themselves, contributing to the economy, and just not showing up in the stats? But I don't know what the answer would be for Australia.
Okay, thank you. On the screen with the employment participation rates and recessions, what do the dark blue line solid represent?
Oh, I'm sorry. Those are recessions. Those dark vertical lines are when the recessions occurred. The straight lines that run through, let me back up here, the straight lines that run through the actual data points are trend lines. So these dark vertical lines are the recession. That's the recession in the beginning of the 90s. This is the one in the early 2000s, and this is the financial crisis. And the thickness is how long it lasts. These lines are simply trend lines because one of the things we have looked at in the past, and not so much as a point today, but the fact that this particular trend line here took a really long time to turn around, because you could see it essentially there was a pickup off the 75% number right here, then it flatlined again for another year plus before it really began to turn around. So we put trend lines in here to point out that the differences in rates of recovery when that was frankly more of an issue than it is now. I probably should take those trend lines off because I think they're confusing. But the vertical lines are recessions, and that's what explains the big drops.
Okay. A question here, does the Fed funds rate really matter considering the size of excess reserves? The Fed knows that the balance sheet is more relevant than the Fed funds rate. Furthermore, doesn't it benefit the banks the higher the IOER goes?
Yeah, I think the Fed funds mattered much more psychologically than in any practical sense. And I think the Fed, in terms of waiting till March or even June, which I think may be more likely before they do anything further, wants to get people to accept that idea. Much as was in the case in the 2000s on those multiple raises Greenspan had. Each individual quarter point raise is not a big deal. It is not the end of the world as we know it. It is simply an adjustment that has technical impacts and some impacts on the banking system, but they're not significant for the real economy. But getting off zero was headlines, as we saw with the taper tantrum in 13, and had a significant psychological effect. But I agree. I don't really think it makes a whole heck of a lot of difference. And just to pick up on a thought I just threw out there, I think June versus March is more likely because I think June is a dead month in the political calendar. March is not. I think the Fed has to raise rates twice before the election. So they're essentially saying they did not make a mistake. If we raise only once and never raise again, it will be viewed as a mistake. So they feel they have, I think they feel they have to raise at least twice this year. But I'm also of the opinion they do not want to raise a lot. They do not want to raise, what did Greenspan do, and Bernanke 24 times, just boom, 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 quarter point each time, and get blamed for the next Great Recession.
Okay, another question is, what is the effect of people staying in the workforce to a much older age?
Well, there's both a cause and effect. So the cause is generally, and it shows up in savings rates after the financial crisis. The return we all realize on our savings is a lot less than it used to be. So we're all told that we have to work a good bit longer to finance retirement. There's not, are people staying in the labor force longer? Yes, a little. I don't think it's having a significant impact on the economy yet, and I'm not sure that it will. I think it's, there may be a slight stretching in how long people stay in the labor force, but I don't think a significant one. And again, the disposable income numbers are not showing that labor force non-participation by younger people is being made up for in the economy by older people staying in the workforce longer. So I think it's a consequence of low savings rates and or low returns on savings, I should say. And once those returns on savings return to something more like normal, or at least close to the rate of inflation, so you're zero real, if you will, we're going to see people deciding that retirement is retirement, and there will be some who work till they drop, and there will be plenty of people who decide that they want to enjoy their retirement and they're not going to stay in their same job till they're 85 years old. But yeah, it has an impact, but it's not showing up in the data in a positive way.
Thank you. Can the Fed hike further while Europe, Japan, and other countries are easing?
Hike further? No, not if they continue to ease. And I think that was one of the important things. And again, if you think about the global reaction to the Fed announcement in December, the European and Chinese central banks, or was it European and Japanese, both said that they were not planning any further easing. So the interest rate cuts in Europe and in Asia in 2014 were the equivalent of a narrowly targeted, if you will, interest rate increase on the U.S. because export-sensitive goods became more expensive. Goods that were sensitive to import competition became more expensive. We all essentially got a pay raise. We didn't notice it, but we got a pay raise. And if you think back to last spring, we saw a lot of advertising, go to Europe, it's cheap. And that's the way that pay raise was manifested itself. So actions by international central banks will definitely have an impact on what the Fed does. If they were to cut further, the Fed would be in a hard put to continue raising rates. I think they signaled in December they don't want to cut further. I think part of the issue around China is what does that mean for China? I think Europe's actually fairly stable on that, and you saw that in the euro actually bouncing up a little bit after the announcement. And from what we see in our businesses in Europe, it's better than the last few years. It's not good, but the growth outlook's better than it's been.
Thank you. With the tax proposals we're hearing from the Democratic presidential candidates, should Wall Street be concerned? The election's always fun. If we come into the summer with both parties poised to nominate a known item, then I think we're
the focus will quickly turn to the Hill, which is really where fiscal policy has to be. That's really the eye of the needle of fiscal policy has to go through if there are going to be any changes. And it's unlikely that the Hill is going to change, again, if you have two status quo candidates running for the Republican Democratic Party in any material way. So that's sort of the boring, good, and stable scenario. We kind of like it, those of us in the private sector, when the public sector doesn't make our lives more difficult. However, if either or both of the nominees for the two major parties are unknown items, I think we're going to have a turbulent second half of the year as people try and sort out what the implications for that will be on Congress. Congress becomes much more up in the air as to where it goes, as well as the uncertainty of what the policy would be, either on the Democratic side, if Senator Sanders is the nominee and elected, and the types of tax proposals he might have, or someone like Donald Trump on the Republican side. Probably not tax proposals, but again, a very much an unknown item in terms of what fiscal policy might look like, and an unknown item for what the impacts of his nomination might be on the congressional races. I don't think I think Senator Clinton would fall into to the known item camp. Yes, there might be higher tax rates, but I don't think Congress would change if Senator Clinton were the nominee and elected, and if Congress doesn't change, you're not talking about higher tax rates anytime soon.
Thank you. Our final question, is it possible that the decline in labor force participation is due to the economy changing, such as more automation? Some economists are talking about a new industrialization with AI and robots. What are your thoughts about that?
Yes. Is it possible is the question. Yes, it is possible. Same as the huge changes in the 50s were a significant change in how the economy was being structured. And if it is worker displacement, people being replaced by robots, the Fed is right to be worried. That is less income to producers of labor services. And every single one of us on this call has to recognize we sell labor services. That's what we do. We get paid for doing our jobs. We do not sell capital. If you have or at least we don't sell capital if we're sitting in our roles and sitting on this call. If we switch to a more automated labor-intensive, capital-intensive economy, that increases the rewards of the economy to capital, and that changes the social demographic and the income structure in the economy in ways that could be just as dramatic as what we saw from the 50s. So it would be a very big deal, and I think that's one of the things the Fed's trying to understand, the sociologists are trying to understand, and economists are trying to understand, because right now we don't know. Is automation going to simply make us all more productive, as was the case in the 90s, or is it going to displace us and create a large pool of underemployed or unemployed with the implications that has for the economy?
Okay, well, again, Frank, I want to say thank you very much for a really interesting webinar, especially coming with the turmoil we've been seeing in the markets recently, and I appreciate your time. As I mentioned at the start, this webinar was recorded, and everyone will receive a link to the recorded version via the email. Again, thank you, Frank, and thank you, everyone, for attending today's webinar.
All right. Thank you, Tom. Take care, everybody. Bye-bye.